would you define a successful investor? Well, besides making more money, the degree of a successful investor has evolved around the capacity for them to earn returns that are greater than the returns that the overall stock market or a specific index is generating. In other words, a successful investor has been known to be associated with someone who can beat or outperform the market. This emphasis on beating the market has become entrenched in the culture of the financial services industry. For people who make a living managing other people's money through mutual funds or pension funds or other actively managed portfolios, their investing pedigree is, more importantly, their performance bonus, is defined not only by generating positive returns, but also by generating returns that are in excess of the market, or alpha. The pressure to beat the market has now trickled down to the masses, with various investment products coming out that are with a marketing premise that their product will outperform the market. The reality is, to beat the stock market on a consistent year-in, year-out basis is impossible. Even the most iconic and famous investors like Warren Buffett or Peter Lynch have underperformed the market, but still earn a reasonable rate of return on their investments. There is a mountain of evidence out there that has shown that between 70 to 80% of actively managed portfolios cannot even match the rate of return of the stock market indexes. So in spite of all the empirical evidence, I find it fascinating that people are still obsessed with trying to beat the stock market. Why is this? One reason comes down to our inherent human desire to compare ourselves with others. We are benchmark junkies and always will be so. It also has a lot to do with our competitive nature. At the end of the day, it's really about cash. In the investment business, performance bonuses and growing your assets drive a big part of compensation and bonuses. And to justify these bonuses, metrics are important. For portfolio managers, the make or break metric is the ability to generate alpha or outperform the market. Beating the market will require taking on more risk, and many portfolio managers will take liberties to extend their portfolio's risk profile to score some extra bonus points. For the average investor, the whole concept of trying to beat the market should just totally be ignored. A more appropriate benchmark for an individual investor would be to earn a reasonable rate of return that would allow them to meet their long-term financial goals at a level of risk that they are comfortable with. As individual investors, we're not shackled nor judged by peers or Wall Street compensation committees. Leave that neuroticism and insecurity to them. If there is a benchmark that we should strive for, it is to earn returns that are at least greater than the rate of inflation, so that we can preserve our purchasing power from future cost of living increases. Right now, we're living in a world where inflation is running at 1 to 2%, so ideally we should be striving for returns on our investments of at least 1 to 2%. However, history has shown that inflation can easily reach double digits, so making that investments that are constantly inflation protected is always an important thing to do. As human beings, our decision making is framed by recent events, which is known in behavioral economics as recency bias. This means that if our portfolio earned 20% last year, then we're going to expect that portfolio is going to earn 20% the following year. So based on this, what is a reasonable rate of return to expect on stocks? Well, going back 125 years, the average rate of return for stocks factoring inflation has been between 6 to 8%. So if you can get your portfolios to earn between that 6 to 8% range on a good majority of times, then you're doing a pretty good job. And if you're earning beyond that 6 to 8%, well, then that's just gravy. And it's more likely going to offset the years where you're going to be underperforming, because it's going to happen. So the next time somebody talks about how they've beaten the stock market over the last 10 years, smile and move on, because it's highly unlikely. It's okay not to beat the stock market, as long as you're staying disciplined to your long-term investment strategy. When you sign up to invest, remember, you are running a marathon, not a sprint.